Welcome to this week's market update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big story was growing confidence that the US economy can achieve what's called a soft landing, where growth moderates without falling into recession. The latest survey of economists shows growth expected at 1.1% in both the third and fourth quarters, slightly better than before. More importantly, the probability of recession in the next 12 months dropped to 32% from an earlier 35%. This growing confidence reflects an economy that's showing resilience while inflation continues cooling towards the Fed's 2% target. For our portfolios, this balanced scenario supports meaningful stock allocations while keeping quality bonds that benefit from the Fed's gradual approach. When the economy shows strength while inflation pressures ease, it creates an environment where both corporate profits and prices can perform well. A major trade policy shift also caught investor attention this week. The US officially ended a provision that allowed small packages under $800 to enter duty-free, affecting nearly 1.4 billion packages annually, mostly coming from China. Now, these imports face new tariffs and delays, raising costs for businesses and consumers short-term. While some domestic retailers may benefit, this change adds supply chain friction and potential price pressures. This reinforces why we focus on companies with strong pricing power and diverse supply chains that can adapt to changing trade conditions rather than those dependent on specific arrangements. NVIDIA delivered another strong earnings report with sales jumping 56% year over year, though data center revenue came slightly below expectations due to export restrictions affecting China sales. Despite initial volatility, shares recovered as investors focused on forward guidance and continued robust AI demand. As a company representing approximately 8% of the S&P 500, NVIDIA significantly influences market sentiment. While the AI trend remains compelling, valuations are demanding across the sector. We balance this exposure to transformative technology with diversification into other quality growth and cyclical sectors. Now, let's look at what drove our performance over the past week and why we remain confident in our positioning. Royal Bank of Canada was a standout performer with a 5.7% gain this week, contributing meaningfully to our returns. The bank's strong performance reflects robust domestic loan growth and better than expected earnings, signaling healthy consumer and business activity across Canada. This is encouraging given economic concerns elsewhere, suggesting Canadian households and businesses remain financially resilient. Royal Bank demonstrates why we maintain exposure to well-capitalized financial institutions with dominant market positions. As Canada's largest bank, it benefits from scale advantages, diversified revenue streams, and strong capital that allows it to navigate various environments while continuing to grow. The information technology sector led our performance once again, with key holdings including Apple, NVIDIA, Broadcom, Salesforce, Microsoft, and Qualcomm, all contributing strong results. The sector's leadership reflects ongoing trends reshaping business. AI adoption accelerating across industries, cloud transformation expanding, and digital models becoming essential. While tech valuations appear elevated, earnings visibility and growth potential remain compelling. These companies possess the scale and innovation capabilities to capitalize on structural changes in how businesses operate. This creates the infrastructure necessary that may define the next decade of growth. Our emphasis on large cap companies continues providing value, with mega cap holdings like Royal Bank, Apple, Alphabet, NVIDIA, and Tesla all driving performance. This size factor success reflects investor preference for companies with strong balance sheets and resources to navigate the uncertainty. During volatile periods, investors gravitate towards established businesses that adapt while maintaining profitability. These companies possess financial strength to invest in opportunities, weather storms, and benefit from their scale advantages. While we monitor valuation gaps between large and smaller companies, The current environment continues favoring businesses with the resources to consistently execute. Looking ahead, here are the key events we're monitoring that could shape markets in the coming week. Friday brings the August employment report, one of our most important monthly indicators for understanding the labor market and health of the economy. Recent data showed some weakness, with July adding only 73,000 jobs and major downward revisions revealing much softer conditions than initially thought. We'll watch to see if this trend continues or if August shows stabilization. Employment matters enormously because strong job growth supports consumer spending, driving corporate profits. It also heavily influences Fed policy as they aim to maintain maximum employment alongside price stability. Thursday morning brings the Consumer Price Index report for August, providing crucial insight into whether inflation continues its gradual decline towards the Fed's 2% target. July's inflation came in at 2.7% annually, slightly below expectations despite growing tariff concerns. This report helps determine if tariffs will create lasting price pressures or only temporary adjustments. Inflation data directly impacts Fed policy decisions, with lower readings supporting rate cuts, while higher numbers could keep rates elevated for longer. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you here next week.